Right, so we'll kick off now. My name's Stephen. I work for Q Super, but I'm a former financial advisor for Q Invest. I used to give comprehensive advice to clients, but now I give education to everyone. So what I'm going to do today is I'm going to walk you through how you can go through a transition to retirement. I'll talk about the value of advice as well. So there's quite a bit of topics to get through. On the right-hand side of your screen, where all of you put your hands up before, so you can put your hands down now, there will be a question box. If you ask questions in there, I'll be able to answer them as we go. I'll do a pause between topics just to go through any questions that you might have, but feel free to pop any questions in there that you do need to raise. At the very end, I'll do a large question and answer with everyone where I'll answer everything related to superannuation. So as we go through, I'll answer things related to the topic, but at the end, I'll answer anything that you want to know. Plus, I'll give you a phone number to call if you need further information for yourself. So without any further ado, we'll get into the Q Super Transition to Retirement Seminar. Now, I do need to let you know that all the information we provide today is general advice only. It is not personal advice. You can get personal advice from a qualified financial advisor, such as one of our advisors at Q Invest. Now, Q Super, we have a lot of different products. So while you're working, we have the ones that you would be familiar with, the accumulation account and the defined benefit accounts if you've been in government for quite some time. As you go towards retirement, there's an account that you can open up, which is a transition to retirement account, and we'll explain that in a lot more detail. And once you're retired, there's a retirement income account, which is very similar to those TTR accounts, and the lifetime pension. So we'll go through the transition to retirement account in a lot of detail today, but just be aware there's a lot of different accounts that you can hold, and there's a reason why you might hold each one of those. Now, what we're going to talk about today is why you would even consider a transition to retirement account strategy. We're going to talk a little bit about how superannuation is actually taxed, how the strategy works. We're going to go through 2 case studies where you can see how the actual mechanics, the math behind it works, plus some of the things that you can do to ease into retirement with Q Super. So I guess the first question we go through is why would you even consider a transition to retirement strategy? So there's a few reasons why you might consider one, and boosting your super and boosting your income are the main reasons. So if you're working right now, you're probably thinking about, I wouldn't mind dropping a day a week, 2 days a week. That's between you and your payroll. What's between you and Q Super is how much salary reduction you actually have. Now, if you can afford to lose 1 day a week and you don't need money out of your super, happy days. You obviously don't need to open a transition to retirement account. But if you want to, there's ways that you can use this account to boost your super or boost your income as you transition to retirement. And just be aware, you don't need to drop any days at work. So the whole transition to retirement was designed so that you could drop days at work, but you can continue working full time and open up a transition to retirement account. Now, in regards to boosting your super, it can help you be quite tax smart, and we'll explain that through the session. And there is a way to boost your income as well. So it means that you can have more now in retirement and you can switch to part-time work or have a job that suits your life. Now, I just got a message that there's someone that has an issue with audio. I will point out if you do have any issues with audio, just hit F5 and that'll refresh your browser. Generally, it's because you're using Internet Explorer, which a lot of, unfortunately, government computers still have on them. If you switch to Edge or Chrome, you should stop having those issues. The audio drops in and out of Internet Explorer just because it's no longer supported by Microsoft. So a lot of plugins don't support it. So hit F5 if you are having any issues, or switch to Chrome or Edge. Now, a transition to retirement can help you switch to part-time work, or it can be a source of additional income to help you pay down some of those debts that you still have later in life. So get rid of your home loan, your car loan, things like that. So some of the rules that apply to a transition to retirement account: you must receive 1 payment every financial year. You are capped at what you can pull out of a transition to retirement account. So whilst you're still working, you can only take out a maximum of 10% of what you put into a TTR, and a minimum of 4% while you're in a TTR. There is no lump sum withdrawals. So you may have heard colleagues say they open up a transition to retirement account, they've taken a lump sum of 10%. That's not technically accurate, so they have been able to take 10%, but it's an income payment, and that's taxed a little bit differently, and we'll go over taxes in a minute. But most you can get out is 10%, minimum 4%. So let's say you had $1 million in super, and you wanted to get $10,000 out. You don't need to put all $1 million into your account, but you'd need to put in at least $100,000, and if you put in $100,000, you get up to 10% of that, which is the $10,000. All right, so minimum of 4%, maximum of 10% of whatever you put into a transition to retirement account. And those funds can come from your accumulation account or your defined benefit account. So the basic eligibility to open this account is that you have to be at least 59 years of age. You have to be under 65, because once you're over 65, super is actually unrestricted completely. So anyone over 65 has full access to their super, regardless of their work status. You need to put at least $30,000 into this account, so there's a minimum balance requirement. And obviously you'll still be working, otherwise it will be called a retirement income account, which has slightly different rules on it. So some of the features of the Q Super transition to retirement account, we only require a minimum balance of $30,000. So if you were to chuck $30,000 into a transition to retirement account, you're entitled to take between 4 to 10% of that balance of 30 grand. So the most you could take out is $3,000, and the minimum amount you could take out is $1,200. Now obviously you can open up with more money, but the minimum is $30,000. You can use your accumulation funds or your defined benefit funds to open this up. Just be aware that if you do have a defined benefit, once you pull money out of the defined benefit, you can't return it to the defined benefit, but you can return it to accumulation phase. You have flexible payment options, so you don't have to be paid once a year. A lot of people do that because they want as much money as soon as possible, but you can pay yourself fortnightly, quarterly, monthly, annually, however you wish. And you get to choose how you invest your transition to retirement funds. So the only investment option at Q Super that is not available in transition to retirement phase is the lifetime option. But you can choose moderate, balanced, aggressive, social responsible international shares, or even self-invest if you have a transition to retirement account. So that's the basic eligibility to open up a transition to retirement account. Now we're going to have a bit of a chat about how superannuation is actually taxed. Now you and I, we all get taxed at what's called our individual tax rate. So we can be taxed up to 47 cents in the dollar according to our personal income tax bracket. In accumulation phase, your superannuation is taxed, and a lot of people are surprised to find this out, but it's taxed at up to 15%. In a transition to retirement account, you're taxed at the same 15%. So what that means is if in accumulation phase or a transition to retirement phase, let's say you had $100,000 again, just for ease of math, and you made a 10% return, so $10,000. In accumulation phase or transition to retirement phase, up to $1,500 would go to the ATO in taxes. The remaining $8,500 that's left over goes to your accumulation or TTR account. So you're still taxed in accumulation or TTR phase, it's just a tax at a much lower rate than you would be individually. And when I talk about individual tax rates, I'll bring that up in just the next slide, but you get paid essentially. You get taxed at up to 47 cents in the dollar. And in your superannuation goes your 5%, and the rest is your take-home pay. Now, if you salary sacrifice, essentially your employer pays you, you still get taxed, unfortunately, at up to 47 cents in the dollar, you get your take-home pay, but your salary of 5% goes straight into superannuation, gets taxed at 15 cents in the dollar. Now, I've just got a question here, are you taxed in a defined benefit? And the answer is yes. So if you have a defined benefit account, this is only for defined benefit members, doesn't carry over to accumulation account members, but defined benefit members don't put 5% of their salary into superannuation, they put in 5.88%. That 0.88% is to cover that 15% tax. That pool of funds belongs to the state government, and state government pays the necessary taxes to the federal government. But once you retire, you get multiple times salary when you actually get there. But we have a whole session on defined benefit that you can attend. If you go to the Q Super website, you can actually register for a defined benefit only session where it explains defined benefit in a lot more detail. But yes, essentially 15% tax gets taken out of your funds. Now, just looking at a salary sacrifice, so let's say you're on $75,000, and I do acknowledge that there are some people who are earning more than this and some people who are earning less than this on the call. We just use $75,000 because it's a nice, easy figure. But $75,000, if you contribute 5% of your money into superannuation, that works out to be $3,750. Now, if you're earning 75 grand, that's your tax bill of $15,262. Your take-home pay would be just under $56,000, and the full amount goes into superannuation because this one has been taxed at your marginal tax rate. Now, if you decide to salary sacrifice and being taxed, instead of being taxed at that 32 cents in the dollar, 37 cents in the dollar, it's only taxed at 15 cents in the dollar inside of super. So you can see, because we're removing it from your personal tax rate, your tax bill goes down. Your take-home pay actually goes up, but you get less money into superannuation. So the difference between 15 cents in the dollar and your marginal tax rate is what you get to put in your pocket. Now, on someone on $75,000 per year, they're better off by about $731 a year. It's about $15 a week better off in their pocket. Now, this is how most people salary sacrifice. They salary sacrifice at 5% and they pocket the take-home savings. And that's fine when you're young. You've obviously got bills to pay, you've got a mortgage to pay off, you've got a HECS debt, you've probably got a car loan, you're probably in peak debt at that point with your young family. But as you get older, you'll get to a point where you don't need that extra money in your pocket. And what you can do is you can increase what you put into your superannuation. So in this example here, what we've done is we've kept that take-home pay the same. So by keeping our take-home pay the same, that means we salary sacrifice even more. That means our income tax bill drops by even more and our super balance goes up. Keeping in mind they still take out that 15%. So we have a calculator on our website which can help you do this to work out how to keep the same take-home pay. But by salary sacrifice that additional amount, instead of it being in your pocket, if you put it into super, because of the tax benefit, you're about $1,100 better off in superannuation. So we're talking about $22 per week better off if you put it into superannuation. So either way in this example, salary sacrifice has either put more money in your pocket or more money into your superannuation. Now, these are the tax brackets here. It's generally if you earn more than $45,000 per year, we recommend you consider salary sacrifice. And that's because you're being taxed at 34.5%, including Medicare levy. For those of us lucky to be above 120,000, you can see the tax bracket jumps up. And for those of us lucky to be above 250,000, you can see the tax bracket really jumps. Now, for superannuation, as long as you're under $250,000, you're always taxed at 15%. For those of you over $250,000, you're taxed at 30 cents in the dollar, but there's still obviously a tax savings there when you compare it to your marginal tax bracket. Now, the reason we recommend you consider salary sacrifice at $45,000 mark is you can see those lower tax brackets. So between $0 and $18,200, you actually don't pay any tax whatsoever. So if you were to salary sacrifice that into superannuation, you get taxed at 15%. So in this example here, if you earn less than $18,200, you would be better off tax-wise to do a post-tax contribution, not pay any tax at all. Between $18,000 and $45,000, you can see the benefit's quite marginal. So looking at a 6% benefit. Someone in that sort of tax bracket would be eligible for what's called the low income co-contribution. So they might be worth doing a post-tax benefit. So what we recommend is once you earn over $45,000, you consider salary sacrifice. If you're under that or around that area, give us a call because we can give you advice on the best way to make post and pre-tax contributions to get the most benefit from tax and that co-contribution amount. But generally, once you're earning over $45,000 per year, that's when we recommend you consider whether or not salary sacrifice is appropriate for your situation. So what sort of difference will it make? So let's imagine that we started our job at the age of 30. It'd be a great time at university, I'm sure, but 30 years of age, let's say we started a job. Fortunately, we're lucky enough to be on 75 grand per year. So we're going to compare doing nothing, doing that 5% post-tax and pre-tax, and doing it at the same take-home pay. So if you were 30 years of age and on 75 grand for the rest of your career, basically just getting inflationary increases, you can see you would get to almost $900,000. Right, so that would surprise a few people that over a 35-year working career, you could get to that sort of amount in superannuation. Now, if you pocket the take-home pay, remember that take-home pay, you get that extra amount, but your superannuation gets taxed by that a little bit more. That'll get you to $856,000. Not as much, but still a good amount. That said, you've been able to pay off your mortgage quicker, probably be able to pay a few bills out quicker. Now, if you don't pocket that take-home pay and you put that into superannuation as well, you can see you're all the way at $961,000. So just short of $1 million. If you work another year to 66, you will be a millionaire. Now, if you were only getting a super guarantee of 10%, however, you get to $701,000. So you can see through the power of compounding interest, your superannuation will build up, but depending on how you do it, depends on how much money you have at the end. Now, it's easy to say you should put all your dollars into superannuation. There are some caps, and I believe those figures come up later on, but you can only put in $27,500 per year into superannuation. And I definitely acknowledge it's a lot harder to put money into super when you're younger and have a lot more debt than it is when you're more career established, more financially established, when you get closer towards retirement. So the limits that you can put in pre-tax are $27,500. That includes what your employer puts in and anything that you salary sacrifice, so 5% of any voluntary contributions. Now, we'll call out if you have a defined benefit, you're probably aware, but there's a special NTC formula we have to do for you. You probably have to call us every year so we can work out what that amount actually is. But $27,500 includes everything your employer puts in, everything that you put in through RemServe or Smart Salary, or anything that you can claim a tax deduction on as well. If you put more than $27,500 into superannuation, it'll count towards this $110,000 post-tax amount. And if you go over that $27,500, you get a letter from the ATO around October, November saying, hey, you've gone over, you've got two options, pay tax or withdraw it from superannuation. So that $110,000 per year, it'd be nice if you could put that in, but you're able to put in $110,000 every financial year, or you can use 3 years worth of contributions in 1 year, so put in $330,000, but then you can't put anything in next year or the year after. So it's called the bring forward rule. Now, how does this transition to retirement strategy work? So we've learned about the taxes. We know about how the eligibility requirements for a TTR actually work. Let's see the mechanics of it in action. So we all get paid. We all love that. That's the best day of the fortnight. You pay tax. That's not so good, but you have to accept that. You then put some money into your superannuation. Now, the employer puts money into your superannuation as well. What you can do is through RemServe or Smart Salary or through your payroll, depending which department you work for, you can salary sacrifice money into superannuation. You can then open up one of these transition to retirement accounts, which is called an income stream account, very similar to an account-based pension, just slightly different access rules. So this income stream can then top up your take-home pay. So let's go through it in a bit more detail, but once you're over 60, anything that you withdraw from superannuation is tax-free. Whilst you're under age 60, there are some tax that you may need to pay. Essentially, remember that 15% tax we paid going into superannuation? You don't get double taxed on that, so they assume that you've already had that. But if you withdraw any money out from superannuation under age 60 through a transition to retirement account, you have to pay the difference between your marginal tax rate and 15%. So if you already earned, let's say $100,000, once again, just for ease of math, and you pulled $10,000 out of a transition to retirement account, you're in that 34.5% bracket. That means that the difference between that and 15% is what you'd have to pay tax on that $10,000 that you got from a transition to retirement account. So let's look at a bit of a case study now. This is Mary. Mary's 59 years of age. That's important for tax status. She's getting $80,000 per year. Once again, this is just for ease of math. She's got $250,000 in her superannuation. She's got a 5% standard member contribution and her employer's putting in 12.75%. Right, so Mary's just been working her whole life, got a little bit in superannuation, and she'd like to retire. Her goals are, though, essentially is to boost her superannuation but retain her current lifestyle. So we're going to look at how we can be tax smart with this one. So what she's going to use is $225,000 over a $250,000 balance to open up a transition to retirement account. So not all of her super, but almost all of her super. And let's see what sort of difference that this can make. So she's going to maximize what she puts in the superannuation. So she's going to put up to a $27,500 cap. Obviously, that's going to mean her take-home pay gets smaller. So she uses that transition to retirement account to pay her to top her take-home pay back up. So she's on $80,000, remember? Because she's salary sacrificing that $4,000 or that 5%, her taxable income is only $76,000. So that gets taxed at her marginal tax rate. What's left in her pocket is $60,393. Now, that $4,000 goes into superannuation, less that 15% tax, so $3,400 goes into her super. Now, she's going to really increase her contributions to superannuation to $17,300. That means that she's going to have $14,705 go into superannuation. Now, that obviously drops her taxable income by a fair amount, but also drops her take-home pay by a fair amount as well. And I will just point out there is a recording of this that you'll be able to click on later to review these figures if you wish. Now, that transition to retirement account that she had $225,000 in it, she's going to pay herself $10,820, which tops her take-home pay back up to what it was originally. So she's salary sacrificing a lot more into her superannuation, and this transition to retirement account is going to pay her some money. So currently, this is how she was doing it, that $4,000, employer contribution of $10,000, which is the 12.75%. Her super balance would have gotten up by $12,070. If she does this transition to retirement strategy under age 60, you can see there's not a huge benefit because she's still paying that 15% tax on withdrawals. But she would be better off in superannuation by about $500 for using a TTR account. Now, who would like an extra $500? I've definitely got my hand up for that one. However, once she turns 60, there's no tax on withdrawals. So at age 60, it means that she's able to put that extra money in and get that money out of her transition to retirement account tax-free. So she's better off in superannuation by about $2,653. Right, so you can see once you turn 60, it becomes more effective. And as that cap goes up, so it used to be $25,000, it's gone up to $27,500. As that cap goes up, the ability to get a bigger tax break goes up as well. So the boost that we're looking at here is that she would be at $425,700 if she just kept doing what she was doing. And that's quite good. At retirement at age 67, she'd be on track for very close to a comfortable lifestyle in retirement, including a superannuation and money from the age pension. If she uses this transition to retirement strategy, however, so just by being a little bit tax smart, she'd get to $448,800. So she's able to boost her superannuation, retain her current lifestyle, and keep the same take-home pay. The outcome is basically by age 67, she's got a boost because of this transition to retirement strategy of $23,100. And the tax that she's saved is $17,300. Now we're going to go through another case study with Mike. So Mike's a little bit different. He doesn't want to boost his super. He wants to work a little bit less. So very similar situation, 59 years of age, has $80,000 of current salary, $250,000 in super, so everything exactly the same as Mary. But his goals are to reduce his working hours to 4 days per week, but retain his current lifestyle. So he wants the exact same take-home pay. So working less, same money. So similar to him, he'll have a reduced income because he works 1 day a week less. The income stream or the transition to retirement account is going to top him back up. So because he's working part-time, he's no longer at $80,000, he's now on $64,000 per year. So he's working 80% of what he used to. His taxable income, because he's still putting his 5% into superannuation, means his take-home pay has dropped. He's still doing his $3,200 salary sacrifice, less that 15% contribution, so $2,720 actually makes it into superannuation. But he's going to top up that day that he's lost at work with his transition to retirement account. All right, so let's have a look. His current situation here, you can see that he was putting that amount into super. It was going up by $9,656. Now, if he does his transition to retirement account, you can see super balance will only increase by $2,714. So a little bit less than superannuation because he's pulling money out, he's accessing money to top up his take-home pay. Once he turns 60, because there's no tax on that, you can see the amount that he's pulling out isn't as bad because of the tax savings. So let's look at this a little bit differently. So let's look at the bar graph because that's the easy one to understand. If he didn't drop a day at work, he would get $425,700, similar to what Mary would. By dropping that day at work and paying himself out of his transition to retirement strategy, his superannuation still grows. So he originally had $250,000. He's going to get to $329,500. So it won't be quite as high as Mary's account will be, but he's been able to work 1 day a week less at work for the last 8 years. That's quite valuable for him. So he gets to retirement age at 67 with $329,000 in his superannuation account. So his goals were to work 4 days a week and keep his same take-home pay, and he's done that. At 67, he can still retire with an overall balance of just under $330,000. He's received over $86,000 worth of income out of his transition to retirement account, and he's saved about $43,000 in taxes as well by doing this. So it is quite easy to ease into retirement with us. Now, the process to open up a transition to retirement account is quite simple. All you need to do is transfer an amount from your QSuper defined benefit or accumulation account, and that's simple as jumping on the website through Member Online. You tell us how much you want to be paid and how often you want to be paid. You choose which investment option that you want to be in, and you can nominate a beneficiary, so who gets your money if you were to pass away. once you've submitted that across to us, and honestly it takes about 2 minutes to do, probably 10 minutes the first time you do it. Once you submitted that to us, we'll process that forms, and about 7 business days later you'll have an income account opened, and we pay everyone in the same pay cycle as government pay cycles work. So every fortnight you get paid, you'll continue getting paid. If you've chosen another frequency, such as monthly, quarterly, annually, you'll be paid on the 27th of the month. So is this strategy actually right for you? So you've got to think about your situation. If you're already doing the $27,500 into superannuation and you don't need to access any money, well then you wouldn't consider a transition to retirement strategy. You'd only consider if you couldn't get to that $27,500 naturally. So does this strategy actually suit you? And whilst you might have had a colleague 10 years ago who used it and it worked very well for him, it may not help your exact situation. Now, if you are accessing money out of your superannuation, will you have enough money to retire? So an example of this is I've seen someone who's opened up a transition to retirement account at age 55 was when you used to be able to open these accounts up. And they've gotten through basically their entire balance by the time they turn 67. So now that they're retiring at 67, they have to be reliant solely on the age pension. So I'm not sure if they achieved their goals of paying out their house or buying whatever car or caravan that they wished. I do know that they have no superannuation left. So will you have enough money to actually retire? Now, under age 60, the tax benefits aren't as great as when you're over age 60. If you have a defined benefit account, you are taking your money from an account that's guaranteed multiple times by salary. State government's on the hook if there's any sort of market crashes. Same token, if the money goes up, the economy goes up, you don't get any of that benefit as well. But you have to leave the defined benefit. You can't put your money back into the defined benefit scheme. Your defined benefit can remain open, however. You don't need to use the full balance of your defined benefit for a transition to retirement account. A minimum of that $30,000, maximum of the full balance, but you have a full choice about how you use the defined benefit scheme. I'd highly recommend you speak to an advisor, so a Q-Invest advisor first before doing so, and I'll explain a bit more about that in just a minute. And there are some dangers with these strategies as well, and they require a lot of discipline. And the example I give with this was similar to the one that I gave before, but my mother opened up one of these accounts. She got her first payment and she bought a RAV4. Now, it's a lovely car, but that's obviously cost her retirement for her. Now, I am a qualified financial advisor. I can't give you advice today, but I've discussed how to do the strategy with her. She was fully understanding of it. But as soon as she got that money in her bank account, she was like, you know what, I'm going to buy myself a new car. So that's obviously impacted her retirement later on. And you need to be aware of the contribution limits as well. So in the past, the limits were much more generous. They used to be unlimited. They dropped down to 50,000, then 35 or 30,000, depending on how old you were. They dropped all the way down to 25,000, but they are back up to $27,500 this financial year and next financial year. Now, if you go over those caps, it counts towards that $110,000 where there isn't any tax benefit to it, but obviously inside of superannuation, it has the ability to grow quicker because it's only taxed at that 15% as opposed to your marginal tax rate. So it's a good idea to have a chat with a financial advisor when you do anything. A huge benefit of Q Super is that your advice fees are a part of your normal fees, so you don't pay anything additional to get financial advice. You're entitled to 2 financial advice appointments every financial year, and a financial advisor can talk you through how to open up a transition to retirement account. So I'll take into account what your goals are, they'll look at what you have in superannuation, what your budget is, and they'll let you know whether or not it's actually in your best interest to open up a transition to retirement account. They can also help you plan your Q Super retirement, so anything around Q Super accounts that you have, they can give you advice on that. So which investment option to be in, how much to salary sacrifice, which investment account works best for you. They can help you manage your retirement income, so show you the difference between withdrawing more or withdrawing less, how that impacts the longevity of your funds. And they can even review your retirement once you're already retired. So are you on track for that comfortable or modest lifestyle that you're aiming for? So it's now at this point that we throw over to questions. It does once again take about a minute for questions to come through to me because we do have a bit of a delay. So chuck any questions that you have on that sidebar. So on the right hand side there's a little question box. Click on that and type anything in there. I will pause for just a minute while I wait for those questions to come through. But obviously Q Super is here to help. We have a contact centre staffed with about 80 people. So if you give us a call on that 1300 360 750, We can help you log on to your member online account. We can reset your passwords. We can talk you through what exactly you have in regards to investment options, insurances and balances. If you already know how to log online, great. Go to qsuper.qed.gov.au and you can manage your account all from online. We even have an app as well that you can look at your account through. If you really want to speak to a financial advisor about what to do next, you can also book an advice appointment online through qsuper.qed.gov.au/advice. And the advisor is obviously there to help